everyone, and welcome to today's SCORE Fairfield County's live webinar on how does your personal budget fit with your small business planning. I'm Bob Hogan, the webinar coordinator today and a business mentor here at SCORE Fairfield County, and I'll be your host. Our presenter today is Jeff Costa. More about Jeff in just a moment, but first I'd like to give you a brief introduction and some information on SCORE. SCORE is a national organization with over 320 chapters across the country and 11,000 volunteers. It was started in the mid-1960s, and we're part of the Small Business Administration. And here locally in Fairfield County, we have over 100 volunteers with a wide range of industry, process, and subject matter expertise. And we offer three primary value-added services to small business owners. We offer one-on-one counseling, which can either be face-to-face, by telephone, email, or by Skype. We offer a wide range of educational workshops and webinars like what we're doing today, about 150 per year. And we also offer extensive resources on our website, including access to subject experts that are always at your disposal. Our next webinar will be 2 weeks from today on September 19th, when Simon Silverleaf and Bob Trinka will present 50 ways to get more customers. Look for specific details on fairfieldcounty.score.org. Today's webinar will end sharply at 1 o'clock, so we respect your time. The webinar is being recorded, and the link to the recording and the slide materials will be available on the website fairfieldcounty.score.org within the next few days. We've set aside some time for questions at the end of Jeff's presentation today, so if you have a question, please use the chat feature anytime during the presentation. It's in the lower left-hand side of the screen. And again, we will take some questions throughout as well as at the end, so feel free to put your questions in the chat box as we go along. It's now my pleasure to introduce Jeff Costa, our speaker. Jeff is an Assistant Vice President and Trust Officer at First County Advisors, the Wealth Management Division of First County Bank, where he is responsible for providing financial planning, trust services, and investment management services to clients. Jeff has been practicing financial planning since 2009 and has experience educating employees of Fortune 500 companies in the workplace. And now I'll turn it over to Jeff. Jeff, all yours.
Good afternoon, everybody. Thank you for joining me on your lunch hour today. So the purpose today is really to provide some tips and tricks to make things a little bit easier for you when you're planning for your small business and trying to figure out how your personal budget fits in with that. Because as a small business owner, everything is very interrelated. Any of your deficit spending is going to affect any of the possible cash flow you might have available when expanding your business or doing anything business planning related. So with that, let's move right along to the agenda. So we'll start off. Section 1 is about the importance of budget planning, followed by integrating personal and business budgets, so kind of where the rubber meets the road. Section 3 is a bit about some of the tax considerations as we work through the budgeting process and perhaps some tips that you haven't heard before, or maybe just some reminders and kind of reinforcement. Section 4 will be a short case study, just a hypothetical, somebody starting a business and trying to figure out how their personal budgeting will impact that new business. And then Section 5 is just an appendix with a little bit of information about First County Bank and myself. So moving right along, we'll start off on the personal budget. Just in any other aspect of financial planning, the budget is really the starting point for everything. If you have no idea how much money you're spending, where it's going, then it's very, very difficult to really do any other high-level planning. If you're in debt, then it's going to make it very difficult for you to figure out your investment planning. If you don't know how much cash you have available to spend, it makes it difficult to figure out what type of insurance coverage you might need or can afford. So everything really comes back to the budget, and planning for your small business is no different. So what we need to start off with first is figuring out an accurate accounting of where your current cash flow is going, and then perhaps through that process trying to figure out some areas where you might be able to save some money, and also perhaps project some trends particularly when it comes to the seasonality of certain businesses or certain expenses that you might have, and moving along. So most Americans never sit down and actually figure out a budget. I can say with pretty much certainty that of 100 clients I would sit down with, maybe 5 actually have a fully written budget that they track in something religiously, like a spreadsheet or a Quicken. And it really does take some dedication to do. But if you don't have that much time to do a super detailed budget, there are some ways that you can kind of get a good handle on what your average expenses are, and not necessarily have to take 2 hours a week going through all your line items and tracking it. So the first thing we'd want to do is take a look at a current assessment. So the easiest thing that I tell most of my clients to start with when they try to figure out what their budget looks like is look at your credit card or bank statements. So if you run everything through a credit card because you want to get points, that actually makes things very easy because it's all on one consolidated statement at the end of the year. Most credit card companies like Chase or anybody else will give you an annual summary, usually broken down in categories. So that can certainly be a big help. If you run everything through a debit card, you'll just have a less organized version of the same thing. Also, a key piece of everybody's monthly expense generally is housing. So whether you're renting or you're owning a home, look at your mortgage or rental statements. That'll give you a lot of great detail, particularly if it's a mortgage, because you'll have an idea of what your property taxes are, and obviously those are deductible items, so important to look at that. Another key piece of the budget for most people is utility bills, particularly living in a climate in the Northeast where you have spikes in heating costs in particular, and then perhaps a spike in electric costs if you run central air or a lot of AC in the summer. So getting an idea of where those peaks and valleys might be in your personal budget is really important because averages are only helpful to a certain degree. You definitely need to know where the ebbs and flows are in your annual budget. Also, it's always a good idea to review any insurance policies and different premiums that you might pay. I know a lot of people are guilty of having those zombie subscriptions where you subscribe to something, you use it for a little while, like perhaps a gym membership, and then you kind of forget that they keep debiting your account. So a good idea to just do some house cleaning and review. Also, very important to take a look at your recent tax returns to get a sense of what your expected tax liabilities might be going forward. Obviously, everybody's taxes change a little bit each year, but at least you might have some semblance of what that tax liability might be, and perhaps you might be able to identify some opportunities to save some in the tax area. So the actual nitty-gritty of creating a budget can be done many different ways. And in the following few slides, we have a couple different examples of what type of budget sheets you can use. There are some that are meant to be more of a kind of tracking tool to see a projected versus actual. You can also, which would be organized on a monthly basis, or you can look at an annual type of budget sheet, which kind of logs the expected ups and downs as you go through the year. For example, as I mentioned before, you know that you're going to be spending $500 a month on an oil drop. You can reflect that in something like that, which is coming up. So I've provided a few different links to those budget sheets, which I have referenced in the slides coming up. And again, there's no wrong way to do it. It really comes down to personal preference and the level of detail that you're looking to accomplish. And just a side note, because I think I glossed over it, but a budget doesn't necessarily need to be restrictive. A budget really needs to just be informative. You just want to know where it's going so you can take action to figure out, how you might be able to optimize. So a budget, just like a diet, doesn't necessarily need to be very restrictive. So a first step of budgeting as well, once you identify your total expenses, what you're currently spending, we always try to categorize a little bit into the needs and wants. And obviously the needs come down to food, clothing, shelter, health care, if you're educating yourself or a child or a dependent, that's always top of the list for many parents. And then retirement savings. You can't get a loan for your own retirement. So very important that you make sure you budget that into your monthly expense. Wants, as you'd expect, things like luxury goods, expensive cars, boats, vacations. And listen, we're not here to tell you that you shouldn't take a vacation, but again, definitely on the list here, we want to make sure that they're prioritized below some of the other columns mentioned before. Dining out, same type of thing. And premium cable, if you're not watching HBO, maybe you should downgrade. So mostly variable, non-essential expenses. And the reason we do this is because once we get into the kind of business side, when we're trying to find cash surplus, particularly when you're starting a new business or trying to expand, these might be some areas where you can sacrifice a little bit in order to further your end goal, which is making that business successful and have a little extra cash flow for investment. So as mentioned prior, here is a sample budget worksheet, which takes a look at kind of what the original budget might be that you're projecting. And at the end of each month, you can go in and look through your statements and say, okay, well, how did I actually do? And overall, it'll calculate, were you under budget this month or were you over budget? And that can help you keep you on track for the annual budget. So if you know you had a big surplus from unspent funds and you need to do something else or you want to take a vacation, this could be helpful to kind of give you an idea of where you're tracking. As mentioned before, there are some more detailed month-over-month, all-on-one sheet type of budgeting spreadsheets and programs out there. This is an example of that. Has all the Excel type of formulas built into it, so you don't have to recreate a whole big thing. You can download a lot of these things online for free, and very easy to work with. And you don't need to know how to kind of write Excel formulas or anything. It's all kind of done for you. So this is one that I really like. If you're diligent and you have the time, this is certainly a good way to do it. For other people, something like a Quicken can accomplish the same type of thing, but it might automatically import or categorize those expenses for you, so you might not have to do some of the legwork yourself. All right. Oops, skipped one. And this is just the bottom sheet of the prior format. So just to kind of give you an idea of some of the categories that you might want to look at. Obviously, healthcare is one that takes up a big chunk for people these days. And then we have things like daily living, groceries, and so on. So moving along, let's talk about mapping out your business budget. Whether you're starting a new business or looking to optimize an existing business, creating a budget is really the starting point, as we mentioned before, that everybody has to do. So we need to look at, first of all, if it's a new business, what are the startup costs associated with this type of business? So definitely helpful if you do some research on your own, maybe talk to some business owners in this current field, or again, go see your local SCORE office. They'll be able to help you with something like that. What type of business is it? Does it have recurring expenses? Usually they do. Typically it could be rent, or if you're paying for a certain type of software, if you're an accountant, you need to have certain types of software, whatever it might be. Is it a retail store? Do you have merchandise? What's the expected upfront that you'll need to purchase to fill your store? Who's going to work there? What are the labor costs going to look like? Does it make sense to locate in Connecticut? Does it make sense to locate your business somewhere else? What are the legal or insurance costs that go along with this? This is a big one that a lot of people don't really think about. Do they need to incorporate as an LLC? to shelter themselves from certain types of liability. All those things, they don't necessarily have to be very expensive, but they are cost, a few $100s here, a few $100s there, $1,000 there. They do add up. So make sure that we try to capture those things in our budget. Also, what are some variables that might increase or decrease some of these costs? So again, this is where it's really important to talk to somebody who perhaps has done it before. Every startup, for the most part, has similar types of expenses upfront. Even though the underlying product or service may differ, the framework is fairly similar when it comes down to it. So now let's talk a little bit about business planning. So before we make the leap into starting our business, we want to think about some key questions. So first off, do we have any idea how long until this business might actually be profitable? So how much cash might I need in reserve if, for example, I don't make any money for the first 6 months or year and a half? Are we paying ourselves a salary out of the business? Again, it all works back to how are you paying the bills? Is there additional revenue in the household from other employment or perhaps a family member to support that business or to supplement the personal and business needs? Do you have an angel investor, whether it's an outside person or somebody in the family? One other item that I just remembered from the last slide, things are always changing in the regulatory or tax environment. So it's really important to make sure that before you jump in and you calculate all these costs, it's really important to take a look and kind of do some research on what might be coming down the pike when it comes to taxes or regulations that might make starting your new business a bit more expensive or maybe impossible, because those things change and they're usually not overnight, but again, if you're not looking for them, people can get surprised. So very important to do your homework and kind of put the ear to the rail and see what's coming. So moving on, although your personal and business expenses and accounts may be very interrelated, it's important for tracking purposes, particularly when it comes to tax time, where you want to segment your accounts. You always want to make sure you maintain a separate business bank account and credit card once you do start that business. It makes it a lot easier to track your revenues and budgets. It simplifies all of your tax accounting and perhaps will reduce your cost of getting your tax documents prepared if your accountant doesn't have to weed through hundreds of pages of summaries to try to figure out what's for your personal taxes and what's for your business. So not only does it help you, but it also helps your accountant. Not that everybody cares whether their accountant gets helped, but generally it comes back to you in the form of savings when it comes to getting the bill. Also, certain types of credit cards may offer different types of incentives to small business owners. You might get a better line of credit. You might get better terms. There might be better travel rewards if it's a business where you have to go visit clients somewhere. It's just a good idea to segment for a whole host of reasons. So on the tax subject, we can't stress enough how important it is to keep accurate records on your business expenses, because this can significantly reduce your tax liability on earnings from your business. Because if you can deduct it, then essentially that's money in your pocket. So if you're not tracking it, that's money that you're leaving out there and that you're entitled to. So there's no reason not to do it. These days, it's really easy to do things like tracking your miles driven for business purposes. You can download apps on your smartphone and start the clock, so to speak. So you don't need to do any log books like the old days. If you use an Easy Pass, that helps tracking your car-related expenses for business. You want to, again, you only use the credit card, your business credit card. If you're buying gas on these trips, just segment it that way. Same thing with any train or air travel. One item that always has a little bit of discussion around it is meals and entertainment, because this is one that has gotten abused many times over the years. And now the IRS is pretty stringent on the restrictions around it. So you want to make sure that you really consult the guidelines. Typically it's subject to a 50% limit, and it also has to be 50% of what they deem to be a reasonable amount. So going out and buying a $400 bottle of wine, they may not, for your client is maybe not a reasonable expense according to the IRS. They may only allow you to expense 50% of $150. So very important to know those things up front before you say, oh, well, I can expense the whole thing and it'll be fine. I'll get at least 30% back. Maybe not the case. Other items to expense, capital equipment. So things like computers, any machinery, if you own a landscaping business or, a car shop or anything you might use, heavy machinery for your business that you can depreciate, that'll help reduce your tax liability each year, as long as it's obviously justifiable for legitimate business purposes. So, getting a Ferrari for your business maybe isn't a legit business expense unless you happen to own a race team or something. Another item which is really helpful for business owners, particularly business owners that are in a high tax bracket, is looking at paying family members who work in the business and directing income their way, because you can potentially pay that. If you have to have that income passing through, it's better to pass it through to somebody who is at a lower tax bracket, perhaps your child that's in college. That might be a better way to do it rather than showing the income on your own income tax, getting taxed on it, and then turning around and paying for your child's tuition. It might be better off to pay the kid through the business, assuming they actually do work. Again, we're trying not to have you get audited, but these are all legitimate things. If the kid is working in the business, making sure that you take advantage of things that might help lower that liability. Also, these things might help ease the tax bite of self-employment related taxes. As most self-employed individuals know, you are responsible for both sides of the Social Security and Medicare tax, which is a pretty hefty chunk. So if you can pass through some of these deductions to reduce that adjusted gross income, that can be a big help. So now we'll shift over to our case study. So we'll set the scene for you here. John, who's 44, is planning to take over a cafe, his favorite cafe that the person maybe is retiring, and he said, it'd be a shame if this place went out of business. I'd like to take it over. So he decides with his wife, Sandra, who's a marketing executive, that he's going to give it a go. So the deal is he's going to pay $25,000 to the prior owner for equipment, furniture, everything that's really in the cafe as it is. And at the moment, his wife, Sandra, is earning $100,000 at her job. And they're trying to figure out how much money to segment from their savings to start the cafe. So they only want to sink a certain amount of money into this business, because if it fails, they don't want to be suffering from irreparable damage. So they currently have $200,000 in savings, and they're willing to dedicate $100,000 of that towards John's new endeavor. So they're trying to figure out, can we accomplish this, and can we accomplish this without really derailing our retirement, perhaps? So we'll explore what questions they should be asking first before they decide to make this purchase and move on. So, as we mentioned before, the first step would really be to dig into their household budget to get a handle on what their current cash flow needs are, and do they have a deficit? Do they have a surplus? How much, if there is a surplus, can we use towards perhaps the new business? And then actually drilling into the expected expenses of that new business. So how much is it going to cost on a monthly basis for this new cafe? Are there variable expenses like food costs, labor costs, the utilities that we can try to forecast on a monthly basis? And then, of course, worst case scenario, if they make no profit or lose money for the first 6 to 12 months or maybe even longer, what's the expected cash depletion from the allocated savings? So now let's try to put some numbers to this case study to give it a little real-world feel. So after doing some due diligence and running through their spreadsheets, they figure out that they have about $2,000 left over each month from Sandra's salary. So that's good. That helps. That'll help offset perhaps any overruns in the business, or obviously if for some reason unexpected emergencies or anything like that in their own personal life comes up, they won't be derailed. So the fixed cost of the new cafe, because they don't own the building, they're just taking over the lease from the current owner, it would be $4,000 a month in rent and other fixed costs of doing business. So all in, they should expect $4,000 a month every month. And then variable expenses, as we mentioned before, it is a cafe. So what do we expect our food costs to be, labor costs, and so on. And obviously this will change based on the amount of traffic that they see in that cafe. So they're thinking it'll be about $3,000 a month for those variable expenses at most, at least in the early year or so. So putting it all together, they figure out with 4,000 fixed costs, another 3 of variable costs, that puts us at about 7,000 total costs for the cafe. And then if we have $2,000 a month in extra cash to help offset that $7,000 sunk into the business, it looks like if they make no money at all, so not just breaking even, if they make no money, then they're looking at a $5,000 a month net loss on their total household cash flow. Obviously $7,000 for the business, but $5,000 when it flows back to real money coming out of their pocket. So if we assume that they spent $25,000 to take over the cafe, and then they had an additional, from that $100,000 original investment that they're willing to make, they have $75,000 left to help offset those upfront costs of running the business for the first year or so. If we divide that by 5,000 net loss, we get 15 months worst case scenario that they can operate this business without making any money at all, which is pretty good. If you can't get it going in 15 months, then it's probably time to hang it up. So I think that probably gives them a pretty reasonable idea of what to expect and have a level of comfort going in that says, hey, we can really make this work, and let's give it a shot. So with that, I would like to perhaps turn it over to some questions and see if there's anything that anyone would like to ask.
Great, thanks, Jeff. As I mentioned earlier, if you have a question, please use the chat feature in the bottom left-hand corner of the screen. Again, Jeff will take questions on really any aspect of today's presentation, or just in general on managing your budget versus your business. It's often an area where we at SCORE get a lot of people trying to figure out how to intertwine the two or how to separate the two. So again, if you have questions, please put them in the chat box below, and we'll get to them right away. just give people a minute or two here, Jeff. No questions so far. Don't be shy, people. Yeah. We have maybe a question coming in a minute. We do have a question here from Adrian Timms, Jeff. It's regarding what are the liability considerations of operating multiple businesses from one business bank account, apart from the tracking issues?
So, Adrian, that's a great question. And personally, I would say that there are a lot of liabilities that go along with that. Again, it all comes down to how your business is originally set up and structured. I would recommend having those businesses separated into different LLCs, because if for some reason you had a claim, you got sued for one reason or another, that somebody tried to come after money that was in that bank, in that account with that bank, they can come after anything that's in that account. So it makes sense to set up separate accounts under separate LLCs for each of those businesses in order to protect yourself and your hard-earned money there. So that's really the main liability, is that they can, if it's in the same account and it's not separated, under different LLCs, it is all at risk.
Great, thanks, Jeff. We have another one from Michael Johnson. He says, I'm 55. Can I use my 401k to fund my new business?
So, Michael, actually, at 55 in a 401k, you can always use that money, different from an IRA, which you have to wait till 59 and a half. You can always draw money out at 55. A lot of people don't realize that. The only thing is that you will have to pay ordinary income tax on any of that money that does come out. So you don't get an IRS penalty of 10% as you would for an early withdrawal if it was in a 401k. And also, for those of you who are thinking, well, I have an IRA, maybe not a 401k, there are ways to get money out of an IRA pre-59 and a half without getting a penalty. There is a way, which is a substantially equal series. 72T is the IRS code subsection, and that allows you to take substantially equal series of payments, and that has to last essentially for the longer of 5 years or 59 and a half, whichever is longer. So it's not a decision that you want to take lightly because you are locked into it for a long time.
Okay, great. Thanks, Jeff. We have another one from Vartan Hakupian, who's asking, how many years can you show losses for a new business which will not flag the IRS?
Vartan, that's a great question, and I think that's probably one that you should talk to your CPA about, because I would say it probably depends on the type of business. Certain businesses may have a tendency to show losses for more consecutive years than others. So that's definitely something that I think would depend really on the type of business.
I would agree with that, Jeff. It is very business specific. Question here from Tony Johnson. If you have volunteers that work for you during the summer, are there any costs associated with your events you can attribute to them and use to reduce your tax payments? I provide lunches, transportation, and clothing, such as an event T-shirts.
So, Tony, that sounds reasonable. I would definitely consult with your accountant on that, but it does sound like that would be a legitimate expense that you should be able to use towards reducing your tax liability, because they would be, event-related, legitimate business purposes So whether they're volunteers or not, they are still costs to the business.
Okay, and another question from Heather McWilliam. Do you find designers separate their LLCs for goods versus design services, i.e. consulting? Also, can you go back to before creating a budget slide for a quick re-review?
So as far as the LLC question, that one I do not have enough familiarity with to maybe give you a good answer on that. I'm not sure if Bob might want to jump in on that, or if he would probably defer you to perhaps your attorney or something in that field. But that's something that I wouldn't be able to give you a really solid answer on. So I apologize there, but not really my area of expertise as far as the LLCs for specific types of businesses. That specific where it's consulting versus goods. So apologize, but I don't think I'm probably the best one to give you the answer there.
I can give a comment on that, but maybe do you want to go in the interim? Go back to the one slide.
Yeah. So let's see. Before creating a budget. So are we talking? I'm assuming we're talking about the current assessment. So if Heather wanted to confirm that, but yes, okay, great. So essentially, it makes sense to just kind of go through all of those different annual summaries, bank statements, and try to get a handle on where the money is actually going. And as I mentioned before, those credit card companies tend to do a very good job organizing those annual summaries for you. Also with the mortgage and rental statements, on the mortgage, very important to know your property taxes when it comes down to both tax planning and to get an idea of what expenses might go up every year. Most people don't see their their property tax bill going down. So different from your actual mortgage payment, which is locked in, unless you have a variable rate mortgage that may adjust. It's important to know that is something that will likely go up at least 3 to 5% in most places over a year. And then utility bills, the thing that we stressed before was really the seasonal trends and making sure that you understand what the ebb and flow is of the different bills throughout the year. And I didn't mention before, but I'm glad it's bringing it back up, is that with your personal expenses where you might have a peak and a valley throughout the year, it's important to have an idea of whether or not your business expenses and your personal expenses will both ebb and flow at the same time, or peak and valley at the same time, or will they be at the opposite? Meaning, if your personal expenses are at a time, say in the summer, happen to be really high, and your expected revenue or profit from your business is exceptionally low due to the seasonality because people are away or whatever it might be, you might want to know that up front so that you can keep an excess cash flow reserve for that period of the year. So really important to have that. And then again, just checking your insurance policies and premiums, making sure that they are the best policies for what you need, and also that they're competitive in their pricing. Always good to shop it every few years. And then also making sure that you have an idea of what your expected tax liability might be, and then budgeting for things like quarterly tax payments.
Great, thanks, Jeff. Maybe just a comment, Heather, on your question about using separate LLCs for goods versus design services or consulting services. At SCORE, I think we see it both ways. Generally, there's no real advantage to separating the two. If it's one business and they're intertwined with goods and services, you can certainly operate, do both activities through the same LLC. The one reason you might separate it is if they got large and you wanted to separate the profitability or protect the liability from one LLC to the other. But again, it's something that you might want to talk through with your accountant or your attorneys. But I think I would say in general, most people would start off with the one LLC, and then if it got larger and there were liability reasons for separating the two, then you might want to do it. When you do have two LLCs, you have twice the work, if you like, in terms of the record keeping and things like that. So, are there any or are there any more questions that we have for Jeff? We've had a pretty good dialogue here. Again, doesn't necessarily have to be directly on the presentation. If there are financial planning, budget issues that you want to raise with Jeff here, we'd be glad to take them.
Also, if anybody has questions that they maybe don't want to share, with the rest of the group, I will put up an email or phone that you guys can catch me directly, and we could always have a private chat. So if it's not something you want to air out in front of the rest of the webinar, then totally understand.
We'll just give people maybe another 30 seconds or so to submit questions if they have them. We do have still have some time available, so feel free. Okay, Jeff, it looks like you've covered it very thoroughly and gone through a lot of things. And I'd like to thank Jeff for joining us today at SCORE, and also remind people that we do have 2 webinars each month, and that the next one is 2 weeks from today on the 19th. Topic is 50 Ways to Get More Customers with Simon Silverleaf and Bob Trinka presenting. And so again, thanks everyone for attending and going on our webinar today. But actually, before I sign off, I'm just having one more question has just come in from Barton. I'm taking this course for SEAP mandate as I'm starting a new business. Can you send me an email that I took this course? I took a similar course. Okay, we will look after that for you. Thank you. Again, thanks again, Jeff, and have a nice day, everyone. Thank you. Well, okay, we're still live, and we have a couple late questions here. One from Ruth Hegney. How do we budget for social media? What is the best way?
So really, that's kind of a tough question generally. It depends on the type of business, how many different channels of social media you're utilizing. So I'm not sure that there's a blanket statement of what the best way to budget for. There are certain pricing types of plans that something like a Facebook or Instagram or Twitter may utilize, where you may pay for a certain amount of sponsored ads up front, and some you may be able to do on an ad hoc basis. So that's something you may want to focus towards one of the social media webinars or seminars that are coming up. We do a lot of those. I know SCORE has a few of those quite frequently, so that might be a good question for them. But sorry, I can't help you a little bit more there, but it does tend to depend, I would think.
Okay, it looks like that is all for today, and thanks again, everyone, and I look forward to seeing you on our next webinar.